Good afternoon, everybody. Welcome to this week's Market Huddle. Most of you already know, but I'm Joe Lucey. I'm the CEO, founder of Secure Retirement, and glad to have you join us here today. This week's Market Huddle. Let's talk a little bit about three key takeaways from our TaxSmart Retirement Summit. This is the event we had on September 30th. At the DoubleTree Hotel. I know some of you actually were able to join us there. I see a couple familiar names, and some of you may not have been able to. So, kind of wanted to just kind of go back and talk a little bit about what I took as three takeaways from our presentation with America's IRA expert. Before I do, here's a little disclaimer. We put this up there. Pretty much every time we do this, it says it basically. I'm not a CPA. I'm not an accountant. I am not an attorney if I talk about something legal. I'm also not I don't work for the federal government if I get into Social Security. So there's the disclaimer that we have there that the attorneys have us do. So here it is, the TaxSmart Retirement Summit. There were over 200 families in the room. Many of you are aware of Ed Slott. He's been a personal mentor of mine for going on. We were calculating it at the event. It's like 12, 13 years now that I've been working with his organization. He has an elite advisor group that he helps financial advisors. Basically, I spend 40 hours a week in sessions with him, getting some continuing education, diving into deep about some real exciting things like private letter rulings and revenue rulings with the IRS and things that may impact families around their IRAs. So, Ed Slott, he is considered the IRA expert. That's by the Wall Street Journal. He's the go-to resource for many in the media when there's something breaking, and he's a pretty busy guy right now with everything going on with proposed tax changes and what have you. And we'll get into that in a little bit. He's also one of the top pledge drivers for PBS, public broadcast television. As you know, if you've ever watched PBS or what have you, a couple times a year, they'll do these episodes and then they go into the breaks and they ask people to call in. And he's been doing that now for a half a dozen years or so. And he's the number one fundraiser for all of public television around the country. And one of the reasons that we were able to get him out here was because he has rewritten the new tax retirement savings time bomb book. The original book is how I found Ed Slott here some 12 years ago. The retirement savings time bomb and how to defuse it. Well, he's rewritten that as of this spring, and it's already New York Times number one bestseller on that list and what have you. So it was a great event, and I got some notes here. I'll come back to the notes if it's okay in a little bit. I see that John has some questions here. One thing that we are doing here, the reason for the webinar is due to some contractual reasons. We were unable to record or to produce the event that we had. In the past, we've been able to do that, but due to some contractual things around Ed's speaking engagement, we are not able to produce that and do a replay. So I see John was asking about the replay. That's not going to be available, unfortunately, due to some contractual reasons beyond Joe Lucey's control. Anyways, let's dive in. What are those three takeaways that I got from the summit and what Ed's presentation was? I guess that we have to start here with taxes, right? Oftentimes families hire us here at Secured Retirement. Well, number one is generally to help them maintain their lifestyle in retirement. They want to be able to maintain their lifestyle. Nobody wants to reduce their lifestyle when they retire, and spend in confidence, knowing the money you spend early in retirement, your late 50s, 60s, wherever that is, that you're not going to wish you had that back in your 70s. Number two is because of our focus on being proactive around tax planning. Families tend to hire us here at Secured Retirement and have us help them with their planning due to the tax planning we do. that unfortunately I think my industry as a whole doesn't always do a great job. Now, the industry as a whole does a good job of focusing on wealth accumulation. So the three reasons people hire us: number one, to make sure that they've got an income stream they can spend in confidence; number two, reducing taxes; and the third, to grow wealth. But we always want to make sure that we're focusing on those first two areas. And generally, when somebody ends up working with us, a lot of times it's because they maybe have complete planning in one or two areas of their retirement planning, but there's an area that's incomplete. And oftentimes what I find is a lot of families, as they transition to retirement, they recognize how important tax planning is, and they want to complete the planning around that. So if you're a current client of ours, of course, hopefully we are exceeding your expectations there. It's something that we pride ourselves in and would like to make sure that we sit down with you again if you don't feel that we're exceeding those expectations. But if you're joining us here today and maybe haven't been working with us, that's something I think a lot of the folks that are on the call would tell you that they get from us here at Secured Retirement and areas that we help complete planning. So think about it though. We are right now in 40-year tax lows. And a lot of folks don't always recognize that, but it's true. Given though a lot of the things around the stimulus spending that we're seeing, you know, we've got now $28 trillion in national debt. And the government, in many ways, we're actually forced to do that because of the pandemic. You know, we're running higher deficits as it compares to the gross domestic product, the GDP of the United States, since we've seen in World War II. And that was actually before the pandemic. But due to the pandemic, we've added another 3.7 trillion of national debt. In fact, you start adding in some of the future promises, we're probably closer to $5 trillion. There's proposals out there right now that are around adding another anywhere from $1.5 to $3 or $4 trillion. They're calling it an infrastructure bill and what have you. And so the national debt is grown more in the last 18 months than it's pretty unprecedented what we're seeing here. On top of that, you know, there's the promise, or one of the things that's been proposed, is that we can probably pay for this on all the spending through additional taxation. In fact, the House Ways and Means Committee here has proposed major tax increases to pay for the up to about $3.5 trillion of the social policies within the bill. They're talking about major changes around estate taxes, capital gains, corporate taxes, and even the way and what kind of retirement accounts may be available to us and who can be available to them. Now, one thing that's kind of been consistent here is that the promise has been that they will not tax families with less than about $400,000 or $450,000. They're saying that that's probably not the case. I'm not sure about that. You know, the Wall Street Journal recently had a headline that read, Biden's plans middle class tax hikes. And then the article, it says that the White House budget team would be looking to shake revenue out of every available American taxpayer. This is a quote from this Wall Street Journal article, to pay for the government's skyrocketing national debt. The article goes on to talk about different areas that the average person may see tax increases, including changes to the capital gains rates, possibly looking at some of the estate taxes that may be imposed, and even possibly changes around the way Social Security, as you know, most of you are aware of this, Social Security in a worst case is only taxed up to 85%, and some proposals around that. Now, on top of that, Forbes had an article, and what they basically had done is they went through some studies that show that corporate tax increases. So beyond the wealthiest individuals, a lot of the proposals around corporate tax changes, and Forbes has reported that the nonpartisan Congressional Joint Committee on Taxation finds that over the next 10 years, low and middle class income taxpayers would end up paying 2/3 of the Biden's corporate tax increases, and that's because companies and what they would pass on through, the inflated pricing and such to go through this. So the one takeaway, whereas we go through these 3 takeaways from Ed Slott's event, is that we want to recognize that taxes are at 40-year lows. They're very likely to go higher. In fact, generally, when we ask somebody if they expect to see taxes going up, it's very rare that we find somebody that says that they don't expect taxes to go higher. And therefore, we want to start doing some changes now. Now, if any of these corporate or the capital gains rates come through, it's unlikely that they would announce that and then defer the actual act going forward. In other words, because if they made a change to the capital gains rate, they very likely would have to make that retroactive. And we may actually already be in a higher capital gains rate than we were earlier this year, maybe last year, because if they do pass the capital gains rates, they can't say that it's going to happen in 30 days because it would clobber the market. So instead, they would have to go back to a date that's already occurred and say, as of this date, taxes changed. What does that really mean? Well, what it means is that I think that the amount of time that we have to really do some good tax planning, it's coming to a close. Now, it doesn't mean that we're going to run out of time. As soon as this starts to go up, it's like when we start seeing impacts of rising interest rates or something. It starts and then it continues for a while. I still think that ultimately those families that take a proactive approach to their tax planning are going to be far better off than those that just wait and kind of go on what Ed Slott talked about, the government plan. If you don't have your own plan, you have the government plan. Number one takeaway from the Ed Slott event that we had, the TaxSmart Retirement Summit, is we want to start taking advantage of the lowest tax rates that we can. And today we are at 40-year lows. Number two, Ed Slott mentioned many times, tax-free is always better than something taxed. Tax-free is always better than something taxed. Now, when you think of your retirement assets, many of us, the largest assets we have happen to be in our IRAs, 401ks, 403bs, thrift saving plans, these retirement accounts that were either established by our employers, or maybe we were setting aside the money ourselves, or if we're self-employed, we were utilizing a SEP or something along those lines, maybe even a 401k. Understand that we were able to put money into these accounts and we got a tax deduction. We were told that the money would grow tax deferred, and then when we took it out, we would be taking it out at a lower rate than when we put it in. We've all been told this. This is what I call the number one lie. Every boomer out there somewhere along the way has heard, you put the money in the retirement accounts, you get a deduction when you put it in, it grows tax deferred, and when it comes out, it's at a lower rate than you put it in. Well, that's untrue for a couple reasons, but maybe the biggest is that our 401ks have been fantastic tools for accumulating assets gross or before tax. But every single retirement account that's out there that has not been taxed, the IRAs, 401ks, 403bs, and so forth, there's a portion of that that is always going to have to go to Uncle Sam. And there's 10,000 boomers a day that are waking up as they retired. That's how many retirees or how many boomers are retiring each day, is about 10,000, that are finding out that not only do they have to pay tax on their distributions, but in many cases, it's going to be at a higher rate. Now, there's a lot of reasons for this. It could be loss of deductions. It could be loss of dependents. It can be just the pure fact that there's a lot of hidden taxes around distributions from IRAs. It's the distribution that is taxable plus maybe additional Social Security. I'll get into that in a second. Could be higher Medicare premiums. A lot of families are surprised to find out that when your income gets above a certain threshold, you have to start paying tax. You pay higher Medicare premiums, which in essence is a tax, right? So understand that the IRS cares very little about your net worth statement. The IRS is always going to focus on that tax return. You file that 1040 tax return every year, and how you or how your income and assets hit that return. And that's how they decide who's going to be means tested, who's going to pay higher Medicare premiums, and so forth. The one area that we see that usually people get caught worst, and basically why Ed Slott wrote his new retirement savings time bomb, is because of the enormous amount of assets that have been put aside in these tax deferred accounts, and families not understanding that a portion of every one of these IRAs is going to be taxed. It'll be taxed by you and your spouse if you're married. If you pass away, your surviving spouse will pay taxes at a higher rate. I call that the widow's penalty. Down the road, the kids pay tax on it. It's a kiddo's penalty. We got the widows, the kiddos, and your own personal taxes. And right now at 40-year lows, if we know that taxes are going higher, the question is, what is it going to be paying, or what kind of tax are we going to be paying in the future? If you had a mortgage on your house and you knew interest rates were going to go up and the amount of payments back into that mortgage to pay off that mortgage was going to increase, you would do everything possible to refinance or lock in a interest rate so it didn't go higher, or pay off that house. Well, when we think of our IRAs, we need to think of it the same way. Our IRAs have a lien against them. It's a tax by Uncle Sam. It's future taxes at an unknown rate, and we need to start thinking about every way possible we can. Now, the good news is this is where secured retirement, this is where we help a lot of families. We've helped most of the families that work with us are working with us in many cases because of the tax planning we do. Where a lot of financial firms either won't allow their advisors to do this kind of tax planning. They rely on the accountant, who's generally looking at what's already occurred in your taxes, not necessarily what tax they're going to do going forward. Or they just don't know this area. That's an area that a lot of families work with us because of the tax planning we do. So the number one takeaway was take advantage of lower tax rates and always pay the least amount of tax you can. The second one is understanding that given the choice between taxed or tax-free is always going to be better. The third takeaway, and I'd spent a lot of time on this, is making sure you have steady sources of income. And in many cases, multiple sources of income are good. Understand, and I said this earlier, Social Security is taxed up to 85%, but many families are aware of that. But what they aren't aware of is that by itself, if that's the only income you needed in retirement, there isn't anybody join us here on today's webinar that would ever pay tax on their Social Security income. And that's because of the way that Social Security is structured. They use what's called a provisional income, and we can go into this in depth if we sit down together. But you want to make sure you understand how Social Security is taxed, and then understand how it's taxed for you, and how you may be able to reposition certain sources of other income to potentially put you in a better position. By itself, Social Security is tax-free, but it's when I start taking withdrawals from those tax-deferred IRAs that we pay tax. Maybe it's a pension. Many families, that may mean if we want to start looking at future taxes and you have a lump sum option, and the income can be comparable to what you would have had through the pension. Maybe, all pensions are annuities. Maybe you look at some of the private annuities that are out there and put that into something that's like a Roth IRA, so we can hedge against future inflation of higher taxes. Now, to me, taxes are just another source of inflation. And when we start thinking about those areas that we're going to pay the most in retirement, it's a lot of times when I ask families, what do you think your biggest expense will be? I'll hear things like healthcare. Maybe it's around housing or groceries. But the reality is that taxes could be the number one area, especially when we start looking at some of those hidden taxes like higher Medicare premiums and such that aren't necessarily called taxes. So what do? Well, we look for ways to move some of this income into tax-free whenever possible. You may not be able to do that with a rental income, but if I can show you ways that we can reduce some of the other income and keep those brackets down, that's something that is generally more favorable The number one way we help families retire securely is we want to make sure that we optimize what I call mailbox income. Mailbox income is money that hits the checkbook regardless of what's going on in Wall Street. In other words, those families that have a steady income, whether it's through Social Security or pensions, especially tax-free pensions, versus someone that's taken withdrawals from their IRAs. The difference when we run into some market volatility, like maybe we saw last spring when COVID hit and the markets were down 37% in a very short period of time, is about those families that know that they have another paycheck coming in a couple weeks, and therefore can ride out any kind of market volatility and what have you. So those are the three takeaways I had. Number one, take advantage of the lowest tax rates possible. Number two, understand that tax-free is always more preferable than taxable. And then the third is making sure we have steady sources of income in retirement, and even better, steady tax-free sources. So the good news is that we can help you if that's an area that you would like to address in your planning, if it's an area that's incomplete. If you are a client of ours and we should be visiting on this again, make sure we schedule a review. Number two, if you're not a client, sit down with us. Maybe sit down with the team here. Let's have a complimentary review, no cost or obligation. Kind of look at your situation. Let's tailor what we learned at the event where we had Ed Slott out there and see what that would mean for you personally. Before I get into how you would schedule that review, next week's Market Huddle, our partner Minneapolis Portfolio Management Group will be giving an update on where they see the markets going and what they're doing in their portfolios. In fact, in the next couple weeks, next week is the MPMG, that's the top one. The Lunch and Learn, that's where you can visit with us face-to-face, have lunch. We generally bring in sandwiches or something. Nate Zeller, our Chief Investment Strategist, our Chartered Financial Analyst, will be giving a Q3 recap and a fourth quarter outlook. So the next couple weeks will be about the markets. And then we have a special lunch just for vets or friends of vets. You don't necessarily have to be a vet. Vets and their guests, on November 10th, we're going to be doing an event. It's at the Marriott here in St. Louis Park. That's not the name of it. It's one of the Marriotts in St. Louis Park here. And special guest, John Creasel. If you don't know who he is, he's a wounded vet. He's a former congressman here in the Twin Cities for Minnesota. And he'll be speaking. And nice way, our goal is to try to find some ways to recognize what vets have done, and hopefully recognize them and give them some valuable information and share a meal. By the way, November 10th, for those of you that are former Marines, you already know that that's Marine Corps birthday. November 11th is obviously Veterans Day. So the book, John, you were asking about the book. Here's how you get the book. It's pretty straightforward. Just schedule a review with us and we'll make sure we get you a signed copy. How do you schedule that review? Well, here's our phone number here, the 952-460-3260. If you schedule that review, we'll make sure we give you a copy. If you're an existing client and have not already received your complimentary copy, just give us a call. We'll make sure we get you that as well. And if you'd rather not call right now, you can schedule there. I think I got it up. You can schedule the calendar right there and put it on the calendar. We'll automatically get a time that we can review. Shoot an email to info@securedretirements.com. So let me see if there was any other questions that I should be addressing before I go. Yeah. All right. So John, just give us a call. We'll talk about how we can get you a copy. So quick recap, 3 things that we learned. Always take advantage of the lowest taxes you can. Number 2, tax-free is better than taxable in the future. And the third one is have multiple sources of income, steady sources of income that aren't relying on what's going on Wall Street. And if they're tax efficient, that's even one better. Until next week, I hope everybody has a great rest of their week and enjoy the rest of your day.